Hello everyone, my name is Merita Isaac and welcome to the A Tutor. Today we are going to look at accounting equation. We are going to solve a practical example under accounting equation. Good. So we are going to take this question. Okay? It says we should show how each of the following transactions can affect the accounting equation, the statement of financial position. Okay. Because you know that for the statement of financial position, it consists of our accounting equation, which is the assets, capital or equity plus liabilities. You get it. Good. So the question is trying to tell us that we should show how each of these transactions will affect the what? Financial position or the accounting equation. Good. And as we already said in the introduction to accounting, that the transaction will always affect two accounts, okay, or more, okay, but it's mostly two accounts, mostly two accounts. Good. So we are going to look at this question. Question 1 says we should question I says purchase goods for resale on credit 250,000 from Adwa. Good. So first of all, what we are going to do is that we are going to write. There is no business name, so we are just going to start with the answer. So we know that the accounting equation is assets equals capital plus liabilities. Good. So we come to I. Okay. I says we purchase goods for resale on credit 250,000 from Adwa. Good. So we have to understand this. Who do we purchase from? We purchase from our trade payable. Okay. Good. So the question says on credit. That means that Adwa here is our trade payable because the people we purchase from on credit, they are trade payable. And as we said in introduction to accounting, the trade payable is a liability. And liabilities are financial obligations that we have no practical duty to avoid. And we have to settle them. Okay, they are people we owe or they are items we owe. Okay, so we have to what? Settle them. And we purchase goods for resale on credit. That means we not pay for the goods we purchase for that moment. We purchase the goods on credit from Adwa. Now we have to identify the account here. So now, as we said, purchase goods here is our inventory, is our stock. And we know that inventory is an asset, is the current asset. Good. So now, the other account here is Adwa. Who is Adwa? We have to identify who Adwa is. Adwa here is a trade payable. Do you get it? Good. So now, let's tackle the question. Purchase goods for resale on credit 250,000 from Adwa. Now, come to think of it, inventory is an asset, trade payable is an asset. What is happening to inventory and what is happening to trade payable? Okay, these two is what the question is trying to tell us, that we should show how they affect the accounting equation or the statement of financial position. Do you get it? Good. So we have inventory to be an asset. When we come here, inventory here. What has happened to inventory? The question says we should show. Okay, it's different from stating. Okay, when we are showing, it's different from stating. So we are going to show by using a plus and minus to indicate a decrease or increase. You get it? Good. So now we could see that here our inventory have what? Increased because we purchased goods. If we had 10, we purchase more in addition to the 10. You get, so there has been an increase in our inventory. Okay, good. So now the inventory has increased by what? 250,000. 250,000. Then we know that here has to be equal to here plus here. You get, so the left side, which is the which contains the assets, because we know that the equation is asset equals capital plus liability. So whatever we get here should be equal to whatever we get here. Yes, and we know that trade payable is a liability, so it's coming to fall under this right side of the accounting equation. So that means that the trade payable here is our liability. So trade payable, which is Adwa, will also increase by 250,000. Yeah. So you see, it's balancing. So at every stage or at every point of the transaction, the left side has to be equal to the right side. Okay. So why did the trade payable increase? We purchased from Adwa on credit. We've not paid Adwa. Therefore, we are owing Adwa. So initially, if we are owing Adwa zero amount, now we owe Adwa 250,000. Even if we are owing Adwa some amount, now we increase the amount we owe Adwa to in addition to what 250,000. You get it? Yeah. So the inventory has increased 250,000. The trade payable has also increased by 250,000. Good. That's our I. Then we go to our II. It says paid rent expenses for last month with check 250 Ghana cedis. So now you have to identify the account here. So what you have to know that we have rent expense here and we have check here. So whenever you see check, it's bank. Okay. So whenever you see check, it's bank. So rent expense for last month. Okay. Rent expense here would have been an expense. But he said rent expense for last month. That means they are always for expense. Okay. So here the account involved here is a rent expense accrued. Okay. Or accrued rent expense. Do you get it? And he said in the introduction to accounting that expenses owing or expenses accrued are what? Liabilities. And specifically current liabilities. Do you get it? So when we say paid rent expense for last month, what has happened to accrued rent expense? That's what you have to think of. What is the other account involved here? We check. Check here is bank. Good. So bank, we know that bank is an asset. Okay. So what has happened to accrued rent expense and bank? Good. So we'll come here. We know that rent expense will fall under accrued rent expense will fall under liability. Then bank will fall under assets. Do you get it? Good. When we come here, write our bank here. Then accrued rent expense. Do you get it? Okay. So now we come to think of it. What has happened to these two accounts? We've been able to identify the accounts involved in that particular transaction. Okay, so what has happened to these two accounts? So now, this paid rent expense for last month, that means we were owing rent expense, approved, we were owing rent. Okay, now we've paid that rent. Okay, 250,000 what? Check. And we know that when there is a decrease in liability, because first of all, we owed rent. And now the question is if we paid rent expense, okay, for last month. That means we are owing rent and now we paid. And from the introduction to accounting, I said when there is a decrease in the liability, we have what? Debit. You get it? But here, there's no debit credit. We are just showing how it affects the accounting equation. Good. So now we will see that from this place, the rent expense or the rent amount we are owing has got decreased by 250,000. So we just write minus 250,000. Okay. We paid it with check. Okay. Paid it with check. So which I said is bank. So we also know that if we have 250 amount of check and we are using it to pay our rent expense, we are not going to get the same amount of check, right? Our check amount has what? Decrease. So a decrease in assets, we have to debit. Sorry, a decrease in assets, we have to credit. But we are not interested in the credit. We are interested in showing how they affect the accounting equation. So you know that our bank amount or check has what also decreased because that's what we use to pay the what rent amount owing. Good. So here is going to be 350,000. So we could easily write 350,000 without any plus, or minus. Okay, because we know that in accounting, when we bring in brackets like this, it means subtraction or decrease or minus. Do you get it? So let's be clear with what we are familiar with. Then as we move further, we'll be introducing the accounting ways. So if it's plus in account, we just leave it like that. But when it's subtraction, we introduce a bracket to indicate it's a subtraction or minus. You get it? Good. So now let's move to the third one. It says sold goods costing 50,000 on credit, 90,000 to advance. Take note. The goods was costing 50,000. Now we sold those goods costing 50,000 on credit to 90,000 to Anas. Anas said we are now selling the goods to Anas. We the business. We are not purchasing now. We are selling to Anas. Okay. So if we are selling to someone on credit, the person we are selling to is our debt or trade receivable. That person is now owing us. You get it? Take note. When we purchase from someone on credit, we are now owing the person. Now we are selling to someone on credit. So that person is now owing us. And if that person is now owing us, that's what we term as trade receivables. Do you get it? Good. So our trade receivables are people that owe us the business. You get it? Good. So we sold goods costing 50,000 on credit what? On credit 90,000 to Anas. Goods that were costing 50,000. We sold it what? 90,000 to Anas. So here we have to identify the account involved, and we know that sold goods, inventory is involved and trade receivables is involved. But we introduce something too. So we know that trade receivable is an asset. Trade receivables is an asset. Then we have inventory too. Inventory too is an asset. So at the end of every transaction, we should get the left side equal to the right side. Good. So now we sold goods costing 50,000. That means if we have 50,000 worth of goods, we sold 50,000 of them. So it has reduced, right? So minus what? 50,000 for inventory. 50,000. So inventory has reduced by 50,000. Then trade receivables. So now we sold to trade receivables and we sold it for 90,000, not 50,000. So therefore, our trade receivables are owing we the business 90,000 because that's the amount we sold to them. Though the goods were costing 50,000, we sold to them 90,000. Okay, so they are going to owe us what? 90,000. So that means the amount the our trade receivables are owing us at what? Now increased what? Or by what? 90,000. Yes, good. So now plus 90,000. Good. So at every point, we are going to see that the left side will be equal to the right side. Okay. Now, if we have goods costing 50,000 and we sold it for 90,000, we are getting profit, right? Profit of what? 90 minus 50, we are getting 40,000. Okay, so we are now seeing that we have a profit of what? 40,000. The 40,000 is for us, the business. It's adding to our capital. As we said in the introduction to accounting, the things that affect the capital are profits, drawings, losses. Now we have profit. So the profit is going to add up to our capital. Do you get it? Good. So now we have profits here. Or we could simply write capital, then we'll show the effects. So the capital here is worth an additional injection of capital of 40,000. So plus 40,000. So you could see that the left side is still equal to the right side. Now let's move to Ivan. Returned goods to Ajwa, a trade payable. Okay, returned goods to Ajwa, a trade payable. Now, Ajwa here is our trade payable. We have to identify the accounts here. Returned goods are inventory. So that's one account here. Then Ajwa trade payable is another account here. You see this one, we have three accounts: profit, capital, trade receivables, and inventory. Okay, so we have three accounts here. So the next one is trade payables and inventory. And we know that inventory is an asset. And we have trade payable. So let's see trade payable. So now what's happening here? We bought goods from trade payables on credit. Now the goods that we bought, they increase our inventory though, but they also increase our liability. Now the goods that we bought, okay, we return those goods back. Okay, so if we return those goods back, what is going to happen to our inventory? Our inventory is definitely going to reduce, right? Because we return those goods that we bought from our trade payables on credit. Those goods have been returned back to our trade payable. You get it? So what is happening to our inventory here? It's going to reduce by that amount, which is what? 25,000. You get it? Good. So our inventory is going to reduce by 25,000 because we had it. We bought it from our trade payables on credit. It was there. Now we say we are returning it back to our trade payables. Okay. So what is going to happen to our trade payable? We bought the goods from you. We didn't pay. We were owing. Then we said, oh, maybe because due to some fault or the things we ordered, and when it came, there were some damages, so we returned it back to you. So what's going to happen to our trade payable? The amount we owe them is going to reduce, right? Because the inventory they sold to us that we are owing them an amount, we return those inventory back to them. So the amount we are going to owe them is going to decrease. Do you get it? Good. So now the amount involved here is 25,000. Good. So let's move to the next question. Vince. The business received interest 500 on its savings account. Good. So now the question here is the business received interest on its savings account. So this one is very tricky to know the account involved, but it's not that tricky. Good. So we have to know that if the business receives an amount, it's a capital injection, okay, into the business is a capital. As the owner introduces money into the business is capital. Same applies here. Do you get it? And we know that any business, any money introduced or any money that is injected into the business, okay, is a capital. Now, it received an interest on its savings account. Where is our savings account? It's in the bank, okay, and definitely we are going to pay through check. And check here is bank. So savings account is in the bank. And definitely we are going to know that the bank is our asset. Do you get it? So first of all, we have to know that the savings account here is in our bank. Okay, so that means that the amount we have in the bank is what? Is invisible. Do you get it? Good. So our assets here will be bank. Injection into the business who received. Do you get it? So it's going to be our capital. An injection into the business. Okay, the business received an amount to our capital. Then we have our savings account, which is in the bank here. So bank. So what is happening to these two accounts? That's what we are going to show. So the business received, and there was an injection. Okay, there was an amount the business received. So the capital injection was going to increase. Do you get it? As the bank will also increase, which is our savings account. If we have, let's say, 10 cedis in our savings account, now the business has received 10 cedis, another 10 cedis in its savings account in the bank. That means the savings account in the bank has also increased. You get it? And the capital or the interest on the savings account also was increased. Do you get what I'm saying? The capital, first of all, will increase because there has been an injection. If there was a previous injection, there has been another injection into the business. The business has received another amount. Do you get it? And now the savings also in the bank has also received an amount. So they are both increasing. Both accounts are increasing. Do you get it? So now the amount involved here is 500 Ghana cedis. So plus 500 Ghana cedis. Do you get it? Good. So now we move to the next one, VI. VI. Purchase prepaid electricity card worth 1,000 at the beginning of the month with cash. Good. Prepaid electricity. Electricity here is an expense. Okay. And we said in the introduction to accounting that prepaid expenses are assets. So what is the expense to electricity? So the prepaid electricity is going to be what? An asset, specifically current asset. Okay, so prepaid electricity. So the account, we found one account and the other account is with cash. So the other account is cash, which is also an asset. Good. So now, the two accounts involved here are assets, but at the end, you should get the left side equal to what? The right side. Do you get it? Good. So now, what has happened to our prepaid electricity and what has happened to our cash? Say we purchased, okay, we purchased prepaid electricity and card worth 1,000 at the beginning with cash. So what did we purchase the prepaid electricity with? Cash. So cash, we know that it will increase. Then purchase electricity, prepaid electricity, we know that it will increase, something like that. So we have prepaid electricity 1,000, so plus 1,000 purchased. So we got, or it increased with what? Cash. That's what the cash is what we use to purchase that item. So our cash now is no more the cash we have already. It is going to what? Decrease. With what? 1,000. You see, left side is still equal to the right side. Okay, good. So then I. When I said, owner gave goods worth 3,000 to a friend as a birthday gift. Okay, the owner gave goods, and we know that when the owner takes from the business as drawings. Okay, so now here specifically is what? Goods drawing, because he took goods out of the business. Good. To a friend as a birthday what? Gift. So the account involved here is what? Goods that are inventory. Do you get it? And drawings. Do you get it? So the term, you have to know the term involved here. The owner took goods, therefore drawings has happened here. And what did we take? The inventory. Okay. So the inventory, which is an asset, is here. Then we have drawings. So you should know what is drawing going to affect. It's going to affect our capital. It's going to decrease our capital. So when we come here, our capital is going to what? Decrease. Because we already know that profit losses drawing will affect our capital. You get good. So now the owner is taking goods from the business. So our capital will reduce by 3,000. Good. And what did he take? Inventory. You've taken inventory out of the business to your friend as what? Birthday gift. Now, if we had 50,000 inventory, you've taken 20,000. We are no more left with 50,000. Okay, we are left with 30,000 now. So that means our inventory has what? Decreased. You get it? Good. So by what? 3,000. So you could see that the left side is equal to the right side. Good. Now we have paid advance and trade payable. So paid advance and trade payable. That's VIII. Okay, good. Paid advance and trade payable 150,000 by check. So we have to identify the account involved here. Okay. So we know that advance and trade payable. It has already specified it for us. Okay, so we know that the account involved here is trade payable and what? Check, which is what? Bank. Good. So we know that the bank is an asset. We have to know where the item is under. Okay. So the bank is an asset. Then we have trade payable. So trade payable is also a liability. Trade payable. Good. Trade payable. Now we will come and identify what is happening to the accounts. Okay, is it increasing, decreasing? Good. So we have paid trade payable. Now we know that trade payables are people we the business are owing. Okay. So if we pay people we are owing, what is going to happen? That means that the amount we owe them has what? Decrease. Okay. So the amount we owe Adwa here is what? Going to decrease. So you have to know that the trade payable is what? Going to decrease by that amount, which is what? 150,000. Good. Then the other account involved here is bank. The check, which I said is bank. Then we know that we paid it with what? Check. Okay, if we had 150,000 amount of check, and we paid our liability, which is a trade payable, the Adwa in this transaction, we paid Adwa 150,000. We don't have that 150,000 anymore. Okay, our bank has what? Decreased. So therefore, our asset is also going to decrease by what? 150,000. Good. So we move to the last transaction. It says, announce a trade receivable return goods 10,000 to the business for 4 packaging. So that's IX. So we have to identify the account here. So the account involved here is announce a trade receivable. So we know that a trade receivable is an asset. Those things we have to know them in our head already. Okay, so we have to know what each account falls under, whether it's an asset, capital, liability. We have to know it. Okay, so trade receivable is an asset. Then return goods. Goods here is our inventory. So we have another what? Asset here. Inventory. Good. So the left side will have to be equal to the right side. So the trade receivable here, what happened to the trade receivable? And now the trade receivable return goods, okay, worth 10,000 to the business. So what is happening to the inventory? Inventory is what? Going to what? Increase, because We sold to you on credit. That's our trade receivable. Now you are owing us. Then you return those goods back to us again. Okay, those goods. So if we had let's say 10 this amount of inventory at our disposal right now, then you brought another 20 cities. Now we have 30 cities. Our inventory has what? Increased. So we are going to see that our inventory has increased by 10,000. Then our trade receivable what? Also decreased by 10,000. Why? Because the trade receivable are people who owe us. Anas is owing us. We sold to Anas. Now Anas has returned goods back to us, okay, due to some reasons, okay. And he said, okay, so he has returned the goods to us worth 10,000. Our inventory has increased by 10,000. Anas will also decrease by 10,000 because Anas is no more going to owe us that 10,000 again because he has bought that goods worth 10,000 back to us. He has returned those goods back to us. So if Anas was to pay 10,000 for those goods, now he has returned it back to us. So Anas here, which is a trade receivable, is not going to owe us that 10,000 here. So the amount Anas will owes us has what? Decreased by what? 10,000. We get it. So this is the inventory is increasing, the trade receivable is increasing. At the end, we know that we see that this side is still equal to this side. Okay, so you can even try it this way. So after the first transaction, when you're going to the second transaction, then you repeat the first transaction again. When we are tackling the second transaction, after that, you add the second transaction to the first transaction and balance it. You will see that at every stage of repeating them, you see that you will still get the same balance. Okay, what I'm trying to say is that, let's say after finishing this place, we'll repeat this place when we are coming to this vein, okay, here again. Repeat this one here again. Before we tackle the actual vein, you will see that after additions and some subtractions, we still get the same balances for both sides. You get it? So that's all for the practice set 1, question 1. So yes, that's all for practice set 1. So we'll end here. Please subscribe, like, comment, and share this video. Thank you very much. We'll see you in the next video.